throughout this chaos, I'm on the record many times saying we will recover these losses. I'm just shocked at how quickly we recovered it and how much the market has moved. Yeah, like I think we make new highs in the next few months. Right. And then you get a kind of euphoric like situation before you get a meaningful pullback. You're lining yourself up for a nice little mini boom in the US economy.
Stock markets have rebounded since their mid-April lows. The S&P 500 is up almost 18% since its trough, gaining back most of the losses since the beginning of the year. Mike Lee is back with us to dissect or discuss what's next with the economy and markets. He is a founder of Michael Lee Strategy. Welcome back to the show, Michael. Good to see you. Last time you were on the show was January. Things were just starting to unravel, and it's looking like a V-shaped recovery. I'll get your thoughts. Welcome back.
Yeah, look, so thank you so much for having me. And so like we talk about the trading year to date, a few separate things have happened in that are what I would say, one of them very related to the tariff tantrum, as I am now calling it, one of them completely unrelated. And the first one was in mid-February. You had the unwinding of some hedge fund strategies, the momentum factor and the growth factor strategies. And what you're looking for in those factor strategies inside of hedge funds is growth increasing quarter over quarter from a lot of these mega cap names, which decelerated in Microsoft's case due to capacity constraints in their cloud unit. NVIDIA, again, with capacity constraints, they're only able to grow their revenue $4 to $5 billion a quarter because of, Taiwan Semi can only pump out so many GPUs. So as that started to come undone, you started to see a lot of air come out of the AI trade and a lot of these high-flying names, because what ends up happening in these pod structures for hedge funds is you may have a $200 million money line, $100 million money line that you can lever up intraday, 5 to 20 to 1, depending on the strategy that you run. But not only will your leverage come down, your money line comes down regardless of performance. So with that, a lot of air came out of the market leading in to the tariff noise. And so when the tariffs came in, there's another hedge fund strategy that really imploded, and that was known as the basis trade. And so with that trade, most people can understand this concept from commodities where you're trading the physical against the future or against a derivative. And so with various treasuries and various futures contracts, there's an arbitrage to be had where you can lever up in some cases 20, 50, 100 to 1 to make very small riskless trades. Well, when you have this much volatility, the historical risk models go throw out the window. A lot of leverage came out. And so while we saw the sell-off, that's why you saw interest rates going higher, which terrified a lot of people. And then also kind of the third aspect is especially in the United States, we're told tariffs are the devil. So anybody that's ever watched The Water Boy with Adam Sandler and his mommy comes out and says, foosball is the devil. That's the way we talk about tariffs here, but they're literally used everywhere else in the world to promote domestic manufacturing, and they have not caused this Armageddon that many were predicting in markets. So I'll say throughout this chaos, I'm on the record many times saying we will recover these losses. I'm just shocked at how quickly we recovered it and how much the market has moved. And boom, yesterday we get a close above the 200-day moving average. So the conversation has gone from like, okay, is the world going to end, to when are we going to be okay, to, oh, wow, it's looking like we've got a lot of ground back, to now, boom, when's the new highs coming? When are we going to make brand new all-time new highs? And I think that needs to be very real. It can happen in the next few months because the long exposure in the hedge fund community is at 5-year lows. So the net long investing, so why does that matter? Because now they need to go out and chase performance, right? And not only that, you have a lot of people that panicked and sold on the institutional level, on the retail level, that are going to want to get back in and get invested so as to not miss out on this in the future, especially with this China de-escalation. So it has been a crazy year, to put it mildly.
Is it fair to say that the markets are not pricing in any of these tariffs to stick?
Whether they are or they aren't, it doesn't really, like, they're nowhere near as big a deal as these people want to say. How much is this possibly going to be in tariff revenue to the United States? 300 billion in a best case scenario, that maybe 400 billion. Well, a gallon of gasoline goes down by $1 in the U.S. economy. That's almost $200 billion back into the economy just from the price of gas. So when you go down $1.50 or $1.75 plus the additional deregulation, from a macroeconomic standpoint, that is a net wash, right? So it's the hysteria over these tariffs is like one part misinformation, one part in America, we just believe because everyone's given the same textbook that the tariffs are the worst things that could ever happen to anyone when it's just not true. They had nothing to do with the Great Depression. I don't care what Wikipedia says or your stupid textbook. We had 9,000 banks fail. 1 in 4 depositors lost every single dollar they had. When you have that sort of banking collapse in the country and consumption gets more than cut in half, okay, I don't care about the tariffs or the trade war that happened. The bulk of them didn't take effect until 2 years after the stock market crash. So tariffs, it'd be better if we didn't have them, but free trade is something that exists in textbooks, in libertarian think tanks, and Narnia. It's not real. It doesn't exist. There is no even playing field. So there's still, even with 10% tariffs on everything that comes in the U.S., we are still the freest and fairest trader in the world because of we have the least non-tariff trade barriers of any country in the world doing business here. So I think there's a level of stupidity that these are going to be hyperinflationary, that they're going to collapse the economy. It's not based in history. It's not based in fact. It's based in lines put in textbooks that aren't always true. And so I don't think it's going to have, especially now that we went to this basically 90-day pause where we're going to have a 10% tariff, or probably slightly higher in certain places. It's not really a big deal. I'd imagine when we look back 12 months from now, the additional revenue to the Treasury, to the United States government, is going to be less than that $300 billion number.
What are you betting on right now in terms of assets then?
Okay, so the stock that I love is CoreWeave. This AI story, tariffs, no tariffs, recession, economic boom, AI is happening, right? And if you've looked at any chart about the data collection and creation. So we're going to create more, we collect and create more data every 2 days than we did from the beginning of the history of the time until the year 2003. It's only a year or two before that's every single day, then every 12 hours. So to sort through that, you need a tremendous amount of computing power. The demand for compute, NVIDIA GPUs and Marvel and AMD and Broadcom and the GPUs they can put forward for AI, that is from 2025 to 2027. That's going to increase by a factor of 9. Okay, CoreWeave had the misfortune of going public 2 weeks or 2 days after Liberation Day. Okay, what CoreWeave does is they stand up data centers. They buy a bunch of NVIDIA GPUs, they put them on server racks, and they rent them out for companies to run their AI projects. Their biggest customers are Google, Microsoft, Facebook. The street is confused about the business model. They don't think this company is going to keep growing, but let's just take a step back. In 2023, they did $230 million in revenue. In 2024, they did $1.8 billion. In 2025, they're going to do $8 billion. Next year, conservatively, $12 billion in revenue. I think the number is going to be more like 16 or more. Okay, it's trading at about 5 times revenue. 5 times earnings in a very conservative manner. I think this stock is a 4 to 5x over the next 18 to 24 months. As people realize this build out of these server farms for AI is not slowing, the growth rate is only what it is right now because of capacity constraints. It's like NVIDIA GPUs. For every one they sell, there's demand for 15. And like, you can tell me all you want that like, oh, Cisco in the 90s and blah, 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 blah. Like, I don't care. This is different. This is the largest technology trend in history. It is the fastest growing technology trend in history, and the speed of which is increasing, not decreasing.
Broad market then. Do you think these particular stocks are going to move independent of the broad markets, or do you think that you're bullish because you're bullish on the broad markets?
So I like that name regardless. I think I think if we get some bad news, right? So like it's hard to see what that bad news could be, but something could happen, right? Where we could have a complete reverse course of China, and these things break down, and we go back to 100 or 150% or whatever, and you could see a pullback. But now we've surpassed that 200-day moving average. I don't know if we'll test that support, when we'll test that support, but there's almost somewhat of a floor in there now, and you have the entire hedge fund community completely offsides with where the market's running. You have inflation prints like we got today creating short squeezes. In the near term, like we could really run 10 to 15% over the next 2 or 3 months and set all-time new highs, right? And that has more to do, I think, with this hedge fund community being completely offsides and earnings coming in better. These tariffs haven't translated into any sort of inflation. If we start ticking down and getting into these low continually get these low 2% inflation reads over the next 3 to 6 months, like what the hell is Jerome Powell doing with rates 4.5%? Like you're so far behind the eight ball. And then all this is happening. The domestic manufacturing situation in the U.S. is going to change dramatically. Everyone has just had a shock into like, hey, I better move my supply chain to the U.S. I better start making things to the U.S. And over the next year or two, the cost of energy, the cost of deregulation coming into effect, and the ability to sell things abroad are all going to work in your favor. Plus, an additional fiscal stimulus through a tax cut, no tax on Social Security, no tax on tips, no tax on overtime. All like that, no tax on Social Security is going to be very stimulative to a large portion of people with money in our country. So everything is coming into alignment right now where you're going to get continual surprises to the upside that in combination with the street simply does not have its arms around the AI trade and the AI trend, how big this is, how big it's, how the speed is increasing, not decreasing. And when you have large institutional buyers offsides the way they are in both AI and the broad market, you set yourself up for an exacerbation to the upside.
Are you ready to meet the biggest minds in Bitcoin and finance face to face? Introducing BTC Vegas, the ultimate Bitcoin event of 2025. Headline speakers this year you'll see in person include Vice President J.D. Vance, Senator Cynthia Lummis, AI and crypto star David Sachs, Bo Hines, the Executive Director of the President's Council of Advisors for Digital Assets, as well as industry titans including Michael Saylor, Lynn Alden, Ross Ulbricht, the Winklevoss twins, and more. Whether you're a hodler, builder, or just Bitcoin curious, BTC Vegas is where ideas ignite, partnerships form, and conviction grows. Tickets are going fast, and prices are going up, so lock in your spot today. Use my link below or scan the QR code here to get 10% discount before tickets get sold out. This summer, the crypto capital of the world isn't Silicon Valley or New York, it's in Vegas, so see you there. Okay, what kind of upside are we talking about for, let's say, the S&P 500? Do you think we're going to retest the highs at the very least?
Yeah, like I think we make new highs in the next few months, right? And then you get a kind of euphoric like situation before you get a meaningful pullback, unless there's some sort of exogenous event, right? Like the shrinking of government, the deregulation, the lower energy prices, this prosperity administration, in combination with fiscal stimulus and significantly lower interest rates, like you're lining yourself up for a nice little mini boom in the U.S. economy.
So what do you mean by significantly lower interest rate? You're talking about the bond market or the Fed funds rate?
Fed funds rate potentially going down to 2.5% within the next 12 months. Probably not priced in, but look at this inflation print today with the tariffs, with everyone with their hair on fire. Okay, we get 2 or 3 more prints like that, it is going to light a match under Jerome. Like the only reason why rates are where they are right now is because Jerome Powell is a partisan hack, working on behalf of the DC elite to do everything they can to sideline Donald Trump. Right? Like there's just no reason for rates to be where they are right now. Right? It's why are we 200 to 250 basis points restrictive? Like, what inflation are you worried about? And even if these tariffs did cause a one-time price shock, Okay, that's not long-term inflationary. You have a reduction in federal deficits. Okay, you have a reduction in energy costs across the board. Increase in productivity from AI that we're already starting to see at the likes of Meta. So I I think you get rates down in the next 18 to 24 months to the 2.5%, 2% range in the front end. You get a 10-year treasury. It'll be interesting to see where that settles with rates at 2%. Do we get down to 3% with a 10-year, or do we get down to 3.5%? Okay, but with this, you're also going to see mortgage rates come in. So it's if you were to sit back, like this is, I make no mistake, this last month from Liberation Day to now has aged me more than any other moment in my career. Right. And like maybe you were short the market because I don't see any gray hairs on your head, David.
They're there. You just have to look for it. But we'll talk about shorting the markets in just a bit. Hey, Mike, so let's look at the other side of the argument. So you're saying that rates should be lower. Okay, some people would agree with you. Well, the Fed certainly doesn't agree. That's why they're not lowering rates. But let's suppose they don't lower rates. Let's just look at the other side. What happens to the economy if they don't lower rates? In other words, they're probably thinking they don't need to, right?
We grow slower. But like, look, it's like 13 months before Powell's gone, right? And then like a new Fed chair will come in and cut rates 100 or 150 basis points immediately, and just paint this guy for the clown that he is. And like it's you have a problem if you're only consuming mainstream news. You're not seeing the total and complete teardown of the institutions in the U.S. in a way to go after Donald Trump. But the Fed at this point to have a complete and total policy about face a week after an election and act like you're an independent agency is just a slap in the face to every objective observer. And so it's lower rates are coming and the market will get there ahead of time. Right. And so today, one number does not a market make. But if we have these 0.1, 0.2, 0.3 month over month core CPI numbers, if that continues to be the case throughout the next 6 months, okay, and you're looking at annualized rates in the low twos, it's a hard case to make that the Fed funds rate should be north of 2.5. How restrictive do you need to be if we're 1/10 or 2/10 of a point above and beyond our 2% target? Right, like why do you need to be there? And then you have all these announcements by all these companies of this $1 trillion and blah 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 blah. I'm gonna spend all this money. That's not going to really come online for a while, but you start to see the beginning of that, like really in actual numbers towards the end of next year. Even if people are like, because let's just say you're going to build a facility. Well, you got to find the location. And once you find the location, you got to figure out who's going to build it for you. Once you figure out who's going to build it for you, there's just a lag effect to that, but that should push the back half of the Trump administration. And if you're increasing manufacturing, if we're increasing our output, increasing productivity with AI, there's not going to be an inflationary aspect to this, especially if we can get the budget deficit under control. And so you're going to bring in a couple $100 billion with, even if we only cut $250 billion from these Doge cuts, we bring in $250 billion from tariffs, and you can cut another $250 billion from all the other nonsense. Well, these are real numbers. It's going to reduce our budget deficit, which has been so wildly inflationary. You start with the mass deportations, which is a $500 billion to $750 billion drain on state, local, and federal governments on an annual basis. Everything is starting to really align, especially if these trade deals follow through to where American manufacturers can produce stuff and actually sell more stuff overseas. So I would like to be this bullish with the market 10% or 15% lower, because it would mean more upside. But I think you're looking at from here over the next 3 years, double-digit returns in the S&P 500, mid-teens returns in the NASDAQ. And some of these AI names, like a CoreWeave, I think that could be a 4 to 5 bagger in the next 18 months. Because a company like that should not be trading at 5 times earnings. It should be trading at 20 to 25 times earnings.
Interesting. Let me take a look at one more chart for you before we wrap up. This is interesting. Changes in net worth, households, and nonprofit organizations. This chart goes back to the fourth quarter of 2024, so it's not perfectly updated. It doesn't include the last quarter yet. It's just interesting how the trend has been down. I wonder if this has any impact on, first of all, the wealth effect and ultimately consumer spending.
So, the rich are rich in this country, right? And so 90% of consumption comes from the top 10%.
Hmm.
And, it just depends how many of these people panic sold and lost a substantial portion of their net worth. Um, I'm looking at this chart. This is a pretty noisy level. This is a
I
pretty
know a
noisy
lot of it
level
is just
chart.
following the markets. I mean, it's corporate equity, so that's stocks. There's real estate, there's debt securities, and as you know, there's quarter four was kind of a bad quarter for the markets. I suspect quarter one 2025 should be even worse. I don't know, but this is changes, right? So I don't know if people adding less wealth overall is going to have an impact on spending and ultimately the markets. Where is this a coincident indicator or leading indicator? No, have you looked at this? Doesn't matter.
Yeah, I mean, I don't, I don't really. It looks pretty lagging to me.
Okay.
Just from the data I see right here, for what we've got going in this. What I would say is, regardless of any of this, these AI companies, the ones that are still like supplying up the hyperscalers. So I wouldn't call Microsoft cheap, but Microsoft's in a pretty good position. If you look at the AMDs of the world, Marvel, Broadcom, particularly AMD and Marvel, they are so incredibly cheap. Like these companies should see double-digit multiple expansion, and they are going to grow as fast. Like you're going to be growing in the 20, 30, 40% range as far as the eye can see, because the build out and the infrastructure needed to service a level of compute that's going to happen. And it's all of these are on hockey stick upward trends. And given where these stocks were trading, where they are now, where they should go, this is a pretty easy generational place to invest in some of these names. Obviously, you want to be involved in the software. My favorite stock of all time is Palantir. It is not cheap, but Palantir, the stock is, you're going to hopefully do 5 billion in sales this year. It's got a $300 billion market cap. And the reason why the stock is so expensive is because the software market for AI is going to be about $60 billion this year. That's expected to be $1 trillion in 2030, according to ServiceNow CEO Bill McMahon. That if Palantir keeps that same market share, they're going to go from 5 to 90 billion, and it'll be at like a 60 to 70% SaaS margin over that period of time. Dan Ives thinks it's going to be $1 trillion stock in the next couple of years. If they can kind of keep that growth with where the market's expected to go, they are. When you take a large language model and you want to marry it to your organization, or dozens of large language models, and have it work for you in the most efficient manner and have every part of your organization talk together, there's only one software solution out there that can do that. That is Palantir. There's never been anything like them. It's an extraordinarily expensive stock. I think you could buy some now. I would be looking to buy more on the dips, but there may not be any dips, regardless of how expensive it is.
Excellent. Thank you very much, Michael. We'll end it here. Where can we follow your work in the meantime?
Yeah, so you can, look up Michael Lee Strategy on YouTube, michaelleestrategy.com. I have an investment newsletter, mikeleeonthemarket.com. You can sign up there. This is what I got.
All right. Fantastic. We'll put the links down below, so make sure to follow Michael Lee there. Take care for now. We'll speak again soon.
Thanks, David.
Thank you for watching. Don't forget to like and subscribe.